First of all, Justin, thank you very much for joining InsurTechTalk. How are you doing today?
Doing great. Thanks for having me.
So we're going to break a little bit the structure of this episode, but to ease people so they can truly feel that we are following almost the same structure, we'll start with you, your personal background. How did you end up starting and launching Shepherd?
Yeah, absolutely. I took an interesting path to insurance, as a lot of people, I'd say, also do, but started my career as a civil engineer. So I was out in the field working on some pretty large scale commercial construction projects. And, I had an interest in construction and I really loved the industry, but was also drawn into the broader operational side and kind of fell into the risk management function within a large contractor by accident, and was mentored by some really brilliant people at some very large commercial contractors. And I ended up running the risk management team at a large contractor in New York City. And obviously that's like the pinnacle of I'd say construction complexity when it comes to insurance is New York. It's the most difficult environment for so many different reasons. And we had a meaningful component of our balance sheet that was self-insured through a captive, and managing that insurance P&L was really my first exposure to the insurance world. I ended up leaving that company to found my first startup, which was completely oriented on construction risk management and how to make my life easier. And we ended up selling that business and landing at Autodesk, which is known for both their construction technology products as well as their design products. And I had the opportunity to run the risk management strategy within the Autodesk construction ecosystem for about 18 months, and really sort of worked on our products and things that impacted our clients on the risk management side, but also built relationships with the insurance community, both brokerage and carrier. And, for me, being on the construction tech side and really feeling the day-to-day impact we were making out in the field on the clients that are using our products, and anecdotally and even empirically telling us, hey, this is the impact that we're seeing on claims and on safety and on our ability to run, higher quality job sites. There was a big disconnect between what we were really feeling on the construction technology side and what the underwriting community was really able to engage on. And so we founded Shepherd really based on that sort of core insight that there was a whole treasure trove of data available about the way that builders operate out in the field that wasn't being used in underwriting. And we wanted to build the underwriting company to do just that. So we founded Shepherd in 2021, and we've been building in the construction and now most recently in the renewable energy space since that time.
Everyone talks about the AI boom in terms of compute, models, and software. I spend my days thinking about something different. Who insures the actual construction of the data centers, energy assets, the project that make all of it possible? The AI race moved from the cloud to the construction site, and the construction site has an insurance problem. I hope that I quote you correctly. It seems to me that the problem is not capacity, and the carriers really want to write AI infrastructure, construction. So what is the problem? Because is it process? Is it speed? Is it data? What made you write this? What made you write this thesis?
I think that there's two elements that are problematic, and I do think the first one is speed. We are in an incredibly aggressive race to build right now. The ability to create compute. The biggest limitation is the physical infrastructure to support it. The demand is there. So whether you're a large, tech company, obviously the Googles and the Metas and the others of the world, or a hyperscaler or an AI labs company, or even some of these frontier builders that are being opportunistic and thinking about how can we create space to sell compute. The race has been incredibly fast, and there is a really kind of critical moment of who can build the most compute the fastest. And so what that creates is a speed need on the insurance side. These projects are moving faster than really any other, like I'd say, infrastructure layer that has existed, at least in my career, but I think in several decades prior to me as well. And so we've positioned Shepherd in so many different ways to meet that speed demand. Often we'll get a submission from a broker, and they need to build a large scale casualty and property program in a matter of days, and so they don't have time to broadcast a submission to hundreds of markets or even dozens of markets and wait for responses to come back. And these builders want to go. They want to move fast, and they want to get a program with quality coverage in place. And so speed is a big problem. And there is so much friction within traditional insurance, especially on the commercial side, that just getting back to broker and a client with a response around coverage, around rate, around terms and conditions is a challenge for most of our broker partners. And so we definitely recognize problem number one is speed. I do think we are entering a new phase where capacity is going to become a larger problem as well. And I think that's because the overall aggregation of building within AI infrastructure is piling up, especially on the property side, like absolutely on the property side. The values and the insurable values, the limit loss that is being required on the property side is incredibly high. It's billions of dollars sometimes on a single project. And so I think there is a shift between, or there is a natural sort of like tension between the desire for insurance companies to support the construction of these assets, which are in many ways more preferred than other types of commercial building for a variety of reasons, and happy to go into that. But at the same time, like the values are so big that we also have to be cognizant of the aggregation of all those values. And so, I do think capacity is a emerging problem, and as we go forward, will continue to become a bigger problem for the industry. It's already something that I see on the property side, and I do think it's starting to bleed into casualty as well.
Yeah. Now, when I was doing a little bit of research to have better questions to ask you, I was a little bit surprised that you're serving about more than 1,500 clients today, or different projects, and the total assets that kind of covered were in 400 billion. And I wasn't sure if that was the TAM or that was specifically the value of the asset or the projects that you are actually today. Then I thought about, these are data centers. Each NVIDIA chip or rack that they have there is in the millions. Yeah, that can quickly sum up and to those numbers. It's but
yeah,
go on.
I would say yes. Data centers are incredibly high value, absolutely, but to be honest, it trickles through the whole industry. The cost of building a high school could reach the billions today. And maybe that's a bit of an exaggeration, but we've certainly seen school county budgets in the billions, and that's going to be multiple schools within the same county that are all doing either new construction or improvements. And so it's not far-fetched to say that sectors like healthcare, educational, life sciences are also building at very large scale. And the complexity of that building is getting bigger. And so material costs have continued to increase as well. And so, the $400 billion of asset value of projects and clients that we are providing coverage to is a pretty diverse mix of asset types. It's actually, data centers is a minority component of that. The majority of what we do is all sorts of commercial building. And again, it could be from all those different sectors. It could also be heavy civil, roads, bridges, tunnels, and things that are just very critical to day-to-day life. So I'd say just construction in general is such a high spend industry, and obviously the spend is going up in so many different sectors.
People don't think about it, but it is. Where was the accident with the bridge that container, the boat, kind of crashed the bridge?
Baltimore, yeah, sure.
Baltimore, right? Yeah, that will take them a few $1 billion just to clear everything and then to rebuild it. And people don't understand how expensive infrastructure is. Bridges, roads, and most of my conversations that I have, for example, with pension funds, it's like, hey, do you have a road or a bridge that we can get, that we can invest in? That's what because they're looking for a 30 years bond from a municipality or from something like that need that infrastructure, and that's what they're looking for. And sadly, I don't have that one on my desk to give them. But yeah, I'm kind of circling back while I really wanted to kind of to touch about what you mentioned in your blog in terms of Louisiana and their purchase relatively to the GDP. And it's kind of in real estate and what we see nowadays in the AI infrastructure construction. But there are a couple of two other elements, which is the data. We touched a little bit about the speed, but in the majority, and the big one is capacity, which we need to talk about it a little bit more, but in a second of that. But so what you're doing today, great. What's a gap, right? You're not the first one who's underwriting infrastructure and construction. What's a gap between you and well, the incumbents?
Yeah, I think that there's a pretty meaningful gap in terms of really understanding and creating the first behavior-based pricing approach in the industry for commercial assets and commercial clients. 20 years ago, the personal auto space went through a pretty massive revolution around telematics data. And what went from being sort of a simplistic approach around pricing, demographics based, kind of simple, a couple data points drive a price, to thousands of data points, creating sort of an algorithmic outcome of what is the right price for a personal auto policy. And we saw some really important winners emerge from that kind of data race, if you will, Progressive and State Farm and some others. I think commercial is going through that same moment. There is data that exists in commercial building, commercial operations, about the way that projects and assets are being run on a day-to-day basis that just frankly did not exist 15 years ago. And that's because, the industry, especially on the construction side, used to be a drawings and pen and paper industry. And so there wasn't a digital record of what was happening out on the job site every month, every day, every week. And the way that insurance companies used to evaluate behavior on job sites is doing loss control, doing risk engineering, sending somebody out to a job site and creating a sort of single point assessment of what is the operation of this contractor look like every day, and then going back to the desk and then trying to use that as predictive towards whether or not they're going to perform well on an insurance policy. We don't have to do that today. We can absolutely still send people to job sites and still, consult and provide engineering. But at the same time, we can plug into those job sites every single day and see what are the activities that are happening. How is the contractor thinking about incident management? How are they managing their inspections? How are they thinking about trade conflict and the overlap of different scopes that could create the potential for quality issues or defect issues? All of these things now live in platforms, in tools that are widely adopted. These are not just sort of like fragmented little solutions. Companies like Procore, who we talk a lot about, are adopted by almost 20,000 contractors across the US. And so when you have this sort of system of record that is governing day-to-day activity of a job site, it creates a really large data set for underwriters like us who are able to intake that data, overlay it against loss performance, and identify where are the signals of the behaviors that lead to the best outcomes. And when we can do that, we can then reward the companies that are investing in these products and in these tools with the best pricing. And so I think the gap to be closed is insurance companies need to not just underwrite the class of business and the location and the litigation environment of a particular project holder. They need to understand the technology stack that contributes to their safety and their quality. And that technology should be part of the underwriting, just like everything else. We feel like we're able to do that in a unique way, but we're also starting to see our competitors and our peers sort of leaning in and saying, okay, like this is clearly the future of how we segment this market differently. And Shepherd is, leading the way, and we're trying to figure out how to replicate that on our side as well.
This is actually mind-blowing. Basically, from a broker that will submit a PDF to you, and then you go and say, I have an eye, it's going to automate, and then I will pass that PDF, or someone will actually read it and process. You're saying, we're changing the paradigm here. We're going to underwrite you based on the technology based on the work that is being done and day-to-day job. What was accomplished, how you're doing, and you're driving all that information from technology that is accessible to everyone. Procore, Autodesk, I assume there are a few other tools that are out there, like maybe Drone Deploy, others. No, that's a new way to approach it. Instead of here's a PDF, go ahead to let me check how does that work is being done in practice and according to that. So, and the data that you managed to pull from it.
Well, I think there's another element of this, which is, and again, I lived this on the contractor side as a client. Historically, the burden of technology and investments, you mentioned a great example, which is Drone Deploy. Drone Deploy is a reality capture platform that is a great partner of ours. They provide air products, obviously drones. They also have ground products, which are folks with cameras that are documenting the job site on a continuous basis. And we have found that customers who use solutions in reality capture tend to see really significant decreases in claim frequency as well as claim severity. And so we often will engage on a client in a project that is moving quickly, and we have either even an owner and a developer who's purchasing an OSIP, who's wrapping up the insurance for that project, or a contractor who's placing their own CSIP, or even something in between where they'll say, hey, this is a project. A contractor controlled insurance program. So basically the idea of a bundled insurance package that is covering all of the different trade contractors on a single job site rather than relying on all of these different parties to bring their own insurance to the project. And so it's an efficient delivery of insurance for a single large scale project. And that can be purchased by a contractor who is like typically the general contractor who's going to go then and employ a number of specialty businesses to come and do trades on that job site. Or it could be the owner who's going to go out and purchase on behalf of everything below them. So that's the contractor and then all the trades as well. And again, generally, when you do that, you create some baseline savings because it's more efficient to wrap everything under one policy. It's also more efficient from a claims perspective. But I think the important thing that gets back to the thesis that we get really excited about is historically that contractor would say, okay, like now I have a large project. It could be a data center, it could be a hospital, it could be an office building. And they're going to say, what technology do we want to use on the job site? And I think Drone Deploy is a great example where the burden has historically always been on the contractor or the owner to go purchase that solution. And they're kind of doing it because it's making their job site more efficient, more productive. There's some value to them, or I mean, there's many values to them, but they're still coming out of pocket on their own to go and utilize that product. The real impact that product makes beyond productivity is safety and quality. It makes contractors and businesses run differently. And so the insurance companies really take benefit when somebody is using one of those tools on the job site. And the data tells us that when we study it. But insurance companies have never created an incentive. And so what we do is we come in and say, hey, there's two prices to this project. Here's premium A, which is you delivering the project as you would, and we've underwritten it, based on our experience and our modeling. Or here's price B, which is if you elect to utilize a technology like Drone Deploy, and we're basically going to help fund that product completely through premium. We're going to provide a savings. Often it's going to exceed the cost of using that technology on the job site, creating a true win-win for the customer. And we find that customers who see a Shepherd Savings proposal, they kind of throw their hands up and say, like, why wouldn't we do this? It makes a lot of sense. So that's where I think that, again, like these gaps exist today, where the contractors and the owners are looking at their own margins and they're saying, well, do I really need to spend the extra dollar on technology for my job site? And financial services providers are just sitting back and waiting for an answer. And for us, we want to lean in and say, actually, let's help you make this decision and also make it cost effective to do so.
There are so many different things here that I would like to break down and then reassemble so we can have a better picture. Let's start with something that we already kind of touched. Most insurance companies, the brokers, everyone, the other MGAs, they use historical data to underwrite. Now, you're kind of offering that, but at the same time, you drive data, live data, real time from the project, and you adjust the pricing. Am I correct, or did I understand it correctly?
So we don't adjust the pricing in real time. Okay. We still lock in on a rate for that particular project. But what we do is we use the signal from data sets coming from technology solutions to create a predictive model around how we think that project will perform. And so we give the value of that upfront to the client. So it's not a variable price that's changing over time. Okay. And generally, because of the buying motion of a lot of these large assets, they're buying insurance up front. They're really sort of locking into a fixed rate. What we're doing is lowering that initial upfront cost so that they can take some of the savings they get back and go invest in the technologies that they're going to also use. What we do is we require the use of that technology on the job site for the duration of the project. And then we also monitor the usage through data integration. So we are providing the client with feedback as well as verification of their use of that product throughout the course of that project, or in the case of a contractor business, throughout the course of the policy term, which is a 12-month policy.
Much better, because it saved me the question about the regulators and how did you manage to convince them to do a UBI for construction, which is awesome, which can be an interesting path in the future. We are not, but that's not the question here. Okay, great. So in that case, the other will be, given the fact that you have the data, you have basically testing, do you want this versus that? So self-selected the type of group. So we want to adopt technology and impact the risk. Have you seen already impact on your loss ratio?
I mean, I think we operate in longer tail lines, and casualty lines do take time to develop. And so it's difficult for me to sit here and say, yeah, I've seen a meaningful, credible loss history or loss ratio impact. I think my actuarial team would come in and beat me up for saying that. I think we feel confident in our results thus far, and I think that we're excited about what we see. But again, it's early. We're 5 years into our journey, which does sound like a long time, but casualty, as you know, is longer tail, and many of these jurisdictions are 7 to 10 year, if not more, statute of limitations or repose. And so anyway, like, long story short is we certainly measure our expected loss ratio and the impact, but we're not ready to go out there and declare in the same way that a shorter tail line of business would be able to do that.
I'm trying to remember who was on the podcast that talked about that. He started his career going through storages of claims that been about 30 years later. So he spent his time in storage in Manchester, just digging out all kinds of workers' comp claims regarding asbestos. So it came up, those claims and the suit came 30, if not 40 years after the exposure. And I'm trying to remember. Maybe it was the one from Lloyd's Association or maybe Aid, but it's one of those. Yeah, it may take time. It may be 2-3 decades later on that the first claim will show up.
I
Quite.
think the certainly like we'll have signal well before then, and
I
there
hope
is limits.
so.
I would say this. I think there's something fundamentally different about what we're trying to build at Shepherd that maybe you would typically see across an MGA that is operating in a space like construction. Um, we've built the whole business around how do we really attract and create an exclusive club for what we consider to be the preferred risks, the ones that are not distressed. Um, and that's different. A lot of MGAs enter markets and they say, "Hey, there's a distressed segment of this market, and we can come in and we can price it better, and we can show that we can use data to sort of do something that everyone else has failed at." For us, we viewed our approach as there are segments within construction that are much more predictable, that are certainly like historically have proven to be more profitable than other segments. And so you
Hmm.
think about commercial building, you think about avoidance of some really difficult environments. We don't do a lot of business in places like New York City, even though it's near and dear to our hearts. It's just a very difficult environment to get right, and many have come and gone from the insurance side within an environment like that. And so Shepherd's entire business plan is how do we attract the companies that most insurance carriers would be excited to write because of their history and their ability to demonstrate long-term sustainable profitable results. And the way that we do that is by recognizing them differently for their use of technology or for their performance, and providing a product that really sort of reflects them and makes them feel like we are the right partner for them long term. So as we look at our portfolio, we say, hey, don't view us in comparison to your typical construction portfolio. You've got to take out the things that really typically have been very, very volatile in this industry. And then we layer on, okay, we've also selected the clients that are leveraging technology the most ambitiously. So as it pertains to like, how do we think about loss performance? A lot of our confidence comes from the fact that we've built a portfolio that we can measure against other portfolios that have, existed and have similar, complexions in our industry. And that's a
So,
baseline for us.
so within your portfolio, I know that we have the data centers for AI, and I bring that because it's cool. I don't know how big, what's the part of your portfolio it takes. But then you also specialize in renewable energy. That's kind of like the second major vertical that published on your website. How do you serve them both, or everything is the same? Any specialties that need to be, addressed there?
Yeah. Um, Maybe just to even back up the thesis behind the expansion, construction is a really incredible through line to so many important industries because it is the creation point of a large physical asset. And so we found ourselves underwriting and supporting obviously AI infrastructure, but a big component of AI infrastructure is the energy. There's really no data center in America that is coming online right now that, or at least is being approved for being built right now, that doesn't have its own independent power component. The grid just cannot yield enough power, and so the demand on power is incredible. And so we found ourselves supporting data centers, but we also saw that many of these assets included either like a renewable energy facility, a battery storage facility on that asset. So within that large, development, there's going to be an energy asset. And so we really sort of viewed it as we already have an insight into how this asset is being built from an energy perspective. And now we want to expand our relationship with that client into the full life cycle once it's producing power. And so we started supporting and expanded into renewable energy operations, very much kind of to like build on top of what we already do within construction. And that's something we intend to do with multiple industries. Renewable energy is its own distinct specialty. And so we have an energy practice leader, we have underwriters. That is a distinct underwriting vertical within Shepherd. We have construction and we have energy. I think the thing that we do differently is we just have more, I'd say, continuity between the teams. Like a lot of large carriers have these like very siloed units, and they finger point at each other and say, well, that's an energy risk, that's a construction risk. Like, we don't really care what you call it as long as we understand what it is, and we'll underwrite it. And so, we do have accounts where we write the construction, and then, we also underwrite the operational phase once that construction is complete. And we think that's like very compounding to our core business. And that's why we expanded into energy. We just see the demand, and we see that renewables is going to be the way to meet the demand at the timeline that is necessary for so many of these assets. But it certainly won't be the last expansion for us. We have many more that we're starting to monitor and even potentially move into and build out on, both in terms of talent and capacity. So that was a deliberate expansion and something that has been very fun and exciting for our team. And we've got some great leadership on the renewable energy side as well.
I had the most interesting conversations on that topic, and not from renewal, but the whole thesis of actually now the data centers trying to move themselves next to the energy source. So the yield of the energy, or even own it. So there were a couple of things in what we call the power industry, or gas and oil, basically. And what the data center company was looking for, can we actually build a data center next to the wells or next to the refinery? In that case, it was a few gas wells with a pipe, and can we get that? And there were a couple of engineering surveys that need to be done and a couple of legal opinion. And so if they can reduce, one of the biggest costs for a data center is the energy cost. And if you own the energy, the internal cost is it's much smaller. So if you own the well, the gas well, the internal cost or internal transfer cost is much cheaper than buying it off the grid, and etc. And then other challenges, but it's a very interesting to see where things are moving, and that now tech needs their own. And I will not be surprised that soon enough we'll see more and more, nuclear, the micronuclear power plants and all this stuff picking up more and more. I know. A lot of people have been talking about it for a very long time. This is not the place, but it's still very interesting.
Yeah, it's certainly coming up a lot. And I think you mentioned, building or moving next to power sources. We've definitely seen that. And we've also seen a lot of new developments that are just inclusive of, it's a completely closed loop system. It's the data center and the data halls and obviously the sort of core assets of the project. And then there's a power asset, there's a storage asset with battery, and then there's also a water system that's a closed loop system. And so, creating these, I think, creating these completely independent closed loops is another direction that we're headed, where, again, if you're a developer and you're able to do that, then you're not reliant on anything. You're completely free to create and obviously bring online your compute as fast as possible. So that's also adding to the complexity and the scale, of these projects. It's not just a couple of, large buildings. It's also now, power, water, and all. Basically it's almost like creating a small town, and almost like a village. We're certainly, seeing a lot of those opportunities where, we treat them distinctively. And I think that's another thing that's emerging. It used to be a little bit one size fits all. We would see a lot of insurance carriers kind of acting the same, but we actually identify 7 different archetypes of data center building. It's quite a large spectrum that we see, and I don't think it's one size fits all. And I think the carriers that are the most thoughtful about the difference between those different archetypes are also going to be the ones that are most successful.
What's the biggest risk for you? Not the macro for industry, but for you in terms of shepherd and running the company. What keeps you up at night?
I think that market cycles are always something that we're trying to get ahead of. We were very fortunate to enter the casualty market at a really good time in 2022, and it stayed pretty consistent for us. It obviously continued to harden into 2023, and then started to kind of reach a little bit of a steady state in 24 and 25, and we continue to see rate need and rate strengthening to be like I'd say consistent, at least in the segments we operate in, a consistent year over year. Um, uh, uh, I'd say stability. We have also not seen like a tremendous amount of new capacity enter the markets that
Oh,
we operate
we
in.
didn't talk about
Um,
capacity, right? Yeah, the
yeah,
capacity gap.
um, it's it, we trade in more of an admitted space. Another example of where we don't typically operate as you would think in MGU, where we only distribute our products through retail brokerage.
Mm-hmm.
Um, we largely bring kind of an admitted appetite and an admitted approach to the markets that we serve, but we trade it a lot like an E&S product, and that's because we're able to take advantage of large scale commercial deregulation when it comes to things like exemptions or state rules, and so we can often rate with freedom and also provide coverage with freedom of form. That's a really like distinct kind of unique advantage that you can have when you're trading in larger commercial versus sort of being anchored to filings and things like that in smaller commercial. So again, like in the admitted space where we operate with retail distribution, we don't see like this massive influx of new players coming in. And so that's created an environment of some relative stability. And that's very helpful to us. But to your question of what keeps me up at night, like, you know, bad actors, folks that are going to come in and try to buy business, races to the bottom, natural cycles of markets. We don't want to just, I mean, part of the reason why we were excited about expanding into another sector beyond construction is we believe that a more enduring business is going to be multi-sector. And that's going to allow us to lean out and lean in at the right times on different markets, both across product lines as well as product sectors. And so, those things keep us up, but at the same time, we're trying to be very proactive about things that could, create risk for the business.
So as these verticals are growing, the main two verticals are growing all the time. So we touched a little bit about capacity. Who provides capacity, and what's a gap? Are we missing capacity? Is it not discovered, or what's a problem?
Well, I think that we're seeing there's a baseline demand for capacity. There's contractual need, and especially on a large commercial asset. Again, these are not $25 million casualty towers. These are oftentimes $100 to $200 million casualty towers, and then on the property side, again, the loss limits could be in the billions. And so what we have found is, I think a lot of the scar tissue that existed in the industry on the casualty side for U.S. casualty for large commercial is around like an over deployment of limit, and so there are still a lot of carriers that are reevaluating their limit deployment and saying, "Hey, I am comfortable with putting up a maximum of $10 million in limit on this risk," and if you went back in time and looked at what they did 5 years prior, they were actually putting up 25 million. And so the clients have the same need for coverage. And in fact, they need more coverage than they had in the past. And each individual market is, I'd say, more conservative on the deployment of that limit. And so that's where the gap gets created, is you have programs that need to be filled with more carriers than ever. And this is where, again, speed really matters. We find that a lot of our broker partners are incredibly tight on timelines, and they are building programs that have dozens of different carriers all syndicating to get to that limit need. And so what happens when that is the case? They don't have a lot of time. They need to start building programs. They're going to go and say, hey, who's the first market that I can go to that I know I'm going to get an answer? I know I'm going to have a fair price, a high quality product. The coverage is going to be correct. The team knows what they're doing. Great, it's Shepherd. Now I can move on to the next layer of this program. And we find ourselves winning not on price in those scenarios. We're winning on speed. We're winning on consistency of product. And again, the way that we can do that, the whole like thesis of the business is apply great technology on our side of the fence so that we're not burdened by a lot of the same frictions that our competitors are bogged down by. Where are we in the InsurTech story? This is obviously the InsurTechTalk podcast. And so I think InsurTech, when we started Shepherd in 2021, InsurTech was like a bad word. You weren't allowed to use it. And I think it was, certainly if we were having conversations with capacity partners, like the advice was stay away from the word InsurTech. And there's good reason for that. And I think it was because, a lot of people did get burned in some of the early waves of insurance tech.
Mm-hmm.
But I actually think that we're in a very different era right now. And I think the topic that I think is really fascinating is the recent announcement by Allianz and Coalition. And, effectively, the story there is that an MGU platform has effectively kind of outperformed a typical large traditional carrier's own ability to underwrite a product. And that large carrier, has basically said, look, this is going to become our exclusive underwriting partner for this line of business. And I think, at least as far as I'm concerned, it's kind of a monumental moment for MGA, MGU. It's really the first time where somebody has said, you know what, the thesis of better data, better underwriting has actually come to fruition to the extent that we're now, going to invest in this third party to own this process globally for us. And I think for a business like Shepherd that is arguing the same thesis of this process of underwriting can be smarter, more accurate, it can be faster, is very much kind of like, for me now, that becomes that is a North Star of how we think about the value of our business. It's about delivering an underwriting result that none of our competitors can match because they don't have the framework and the structure to be able to do it from a technology perspective. And I'm just really excited about that. I think I could talk for hours about how I think that's a pretty seminal moment for InsurTech, and hopefully kind of changes the word, why we can use the word InsurTech or how we use it.
I think this is brilliant. You just answered two questions. One that I kind of skipped, which is part of the questions that I ask about the landscape, the competitor, stuff like that. And because it's InsurTech and most there are MGA founders who are listening, it's more about kind of answer that one, which is, you basically operating in a space that you have large specialty insurance carriers, AIG, Zurich, Liberty, Chubb, etc., and you're writing on someone's paper. I don't know whose paper you're using, and basically competing with them. How do you manage that? How do you operate? How does it fit in the ecosystem? All that relationship. And now you are answering with how Allianz approached and basically shifted their operation to them as their strategic distribution, etc. And then you also answer the last question that I usually ask people: what is the one thing that people in the industry should talk about that they don't talk about? And that's a great answer for that question as well. And if you can talk about it for hours more, please. More insights can only help our audience.
I think that the value of technology and underwriting has largely been unproven from a loss ratio perspective until kind of now. And I think that's really the big shift. I think historically we've talked a lot about distribution advantages or marketing advantages. These are important innovations as well. And I think like creating efficiency around responsiveness and the way that you create a product experience in the market is all really important. It's table stakes for any technology business. But I think it's been a really long time of frankly, founders like me or people in the InsurTech space saying, hey, we actually think that there's an opportunity to outperform the way underwriting works. And for a long time, I think that either reinsurers or carriers have said, like, there's no proof of that, and like it's all talk. And I think for the first time we're starting to see an emergence of real proof points behind the value of technology from an underwriting perspective, and that gets me pumped up. That's exciting. Like
Yeah,
I love that, and I think that we obviously have we have a ways to go to prove that out for our own lines of business, and obviously it's different. Cyber insurance is quite different from construction casualty or energy casualty, or even construction property for that matter. But again, like we believe in the thesis of what we're doing. That's kind of the I'd say naive kind of blessing and curse of being a startup, is like you've got to believe. But we're starting to see that there are real proof points that we can point to, and obviously our own data that we can point to and say, hey, this is the value, and this is why, if you're supporting these segments of the insurance industry today with capacity, like why should you shift that capacity to Shepherd? That's part of our answer.
fantastic. And we'll skip how a broker should reach out to you and what's the expectation and all kinds of other questions that are, very technical, and with one email they can solve it all. And with that, Justin, thank you very, very, very much for joining me today and sharing with the audience your journey and insights about the industry and how it works.
I appreciate that. Thank you, Galad. Thanks for having me.
My pleasure.